$3,200 in car payments? Oh my gosh!
What is your current car payment on that?
Probably over $1,500.
$1,000.
My truck's $850, and I think her truck's actually like $700.
The average price for a new car has now passed
$50,000.
The $50,000.
$50,000.
$50,000.
This is what we've completely normalized. $50,000 for the average vehicle and over $1,000 a month just for something to sit directly in the driveway. And it's led us to a terrifying number, $1.6 trillion. That is what Americans currently owe on their cars. It's a number so large it could buy every NFL, NBA, and MLB teams combined, and still have hundreds of billions of dollars left over. It's more than the collection of all student loans and credit card debt. And this year alone, 3 million of those vehicles are being repossessed as we speak. Remember back in 2008?
This market is as volatile as you'll ever see.
Traders say this is the craziest day they have ever seen in these markets.
This could be the most serious recession in decades. And that means life, as most Americans know it, is about to change.
Realtors were selling homes to people who could not afford them. The banks bent the rules just to write another mortgage. And suddenly the whole house of cards ended up falling down. The exact same thing is happening right now in the car market, just on a car dealership lot instead of the cul-de-sac. So it begs the question, how do so many smart people continue to fall for the same exact trap? Because it is a trap at the end of the day, and it's perfectly designed. If you want to stop getting played by the financial system that's keeping you absolutely broke, leave a like on the video because today we'll be tearing the math wide open. Here's the reality that nobody tells you before you step foot on the dealership lot. The average new car sitting outside of a grocery store currently costs over $50,000. And because of that, the average monthly payment is over $767 a month, with 1 in 5 buyers paying over $1,000 a month. The second you walk through the dealership doors, there are 3 distinct parties that are waiting specifically for you, and they all want the same exact thing. First, the salesman. His job isn't to sell you a car. His job is to make you fall in love with one, to get you smelling that new leather, picturing your kids in the back seat, or helping you imagine what your coworkers would think whenever you drive up to work in that brand new car. Because the moment that you feel emotional about that vehicle is the moment that the math part of your brain completely shuts off. Second, the F&I manager. So this will be the finance and insurance guy, the one that's looking to sell you every single back-end product, whether it be gap insurance, extended warranties, and thousands of dollars of hidden add-ons that they'll add on to the back of your loan and increase that monthly payment, but hide it within the monthly term. And then third, the bank. And they're hiding completely in the background. They win no matter what happens. Because whether you pay off the loan in 7 years or the car gets towed away in the middle of the month, the way that that loan is structured, they get paid first. And all 3 of them use one simple method to keep you absolutely distracted: the monthly payment. Here's the math that no school ever taught you, but every single dealership knows by heart. Let's look at a real example. Say you want a $50,000 truck. You put down 10%, which will be $5,000. You now have a loan for $45,000. Sounds reasonable, right? A brand new car loses roughly 20% of its value the moment the tires hit the street. It drops another 15% in year 2, and on year 3, it drops another 10%. Meanwhile, if you take out an 84-month term, which is 7 years, you're only paying down a fraction of your principal costs within those first 3 years. Everything else is front-loaded to ensure you pay the most interest as soon as possible to assure the bank gets majority of the money up front. Now this in most cases will create what people refer to as negative equity. And in simple terms, all that means is that you owe more on the vehicle than what it's actually worth on the market. And according to recent Edmunds data, over 28% of new vehicles are currently underwater. Now think about that for a second, and let me know if that makes you rethink your next car purchase. Because the next part is where the actual trap snaps shut. When those individuals with an underwater car loan goes to a dealership, the dealership honestly says, no problem, we can make that happen. And we'll just roll that negative equity into the new car loan that we'll get you into. So in this case, not only are you taking out a new car loan, you're also rolling in thousands, if not tens of thousands of dollars into the vehicle that you're actually looking to buy. And this turns into a mathematical death spiral. Make sure that you never focus on that total debt number. Dealerships use 3 psychological tricks. Trick number 1, the 4 square. Your purchase price, the down payment, monthly payment, and then your trade-in value if you're trading a vehicle. And all 4 numbers hit the table at once. The salesman will scratch a number out and flip the paper over to you. And it looks very hectic, but in all honesty, it's highly choreographed. It's designed to induce fatigue and wear you down mentally. Now let's get into the second trick, manufactured scarcity. And I know a lot of you have saw this before. Someone is looking at this exact vehicle and is coming in at 4 p.m. today. This interest rate deal is only available today. In most cases, that's not the truth. They just want you to make a decision as soon as possible to ensure that you don't leave the dealership without making a decision that could possibly ruin your life. The urgency is fake, but your brain hears something completely different and it panics. Okay, trick number 3, the monthly payment redirect. They'll raise the car by a total of $5,000, but on the back end, they'll stretch out the loan term to 84 months. So the monthly payment lowers. Now you'll feel like a master negotiator while agreeing to stay in debt for over a decade. This is not an accident. This is the product. So what happens if you're watching the video right now and you're currently underwater on your vehicle? Now, to be honest with you, you have about 4 options and none of them are fun at all. But you have to act before the depreciation gets any worse. Okay, option 1, this will be to refinance. If your credit score has gotten any better since you've gotten this new vehicle, there is a possibility that you could get the same exact loan term with a lower interest rate. Now, this won't necessarily eat into the depreciation. However, if you, let's say, get a $100 cheaper car payment due to the interest lowering, you could put the additional $100 to principal, thus paying off your loan early, making the same exact payment that you were accustomed to previously. Option 2, you can sell it and eat the loss. It's a clean break, but you do have to come up with the difference depending on how much you owe versus what your loan is. Option number 3, the lockdown. You completely lock down your budget, cut all unnecessary spending, and aggressively overpay your principal balance every single month. It takes incredible discipline and it might hurt for a year or 2, but it'll get you out of your underwater car loan as soon as possible. If you aren't trapped yet, you don't have to play the game. Follow these 3 rules and you'll never have to worry about being underwater on a car loan. Rule number 1, bring your own money. Get pre-approved from your local credit union or bank before you even step foot in the dealership's doors. The dealership will lose its most powerful weapon before you even step foot in that dealership. Rule number 2, calculate your all-in monthly costs. Don't just look at the loan payment. Factor insurance, gas, and maintenance on that vehicle, and the car payment is just the starting point. Very similar to a mortgage. Your mortgage payment's gonna include some of the things, but it won't include your utility costs, your HOA fees, that new roof that's ultimately going to come due. Now, rule number 3, and arguably the most important rule out of all of these, the 20-4-10 rule. I have multiple videos that will also cover this in detail. Depending on how much you make per year, there's a playlist right here that you're welcome to check out after this video. Ultimately, all this rule will be is 20% down, no more than 4 years, and a total of 10% of your gross monthly take-home going towards the actual transportation cost of your vehicle. So again, your car payment, maintenance, gas and or electric, and anything else that goes into the actual transportation as a whole relative to your car payment. Let's quickly do the math on this one. Let's say you take home $75,000 a year. Your monthly car budget, insurance and gas included, should be no more than $625 a month. I'll link down below a car calculator that'll also help you calculate this, just depending on where your salary's at, just to save you some time. And here's the shocking truth. The average American family cannot afford the average new priced vehicle. And this rule exists for one specific reason: to keep you out of debt, to assure that a car purchase does not ruin your financial picture and your life. The car you drive does not determine your success. In fact, it's honestly one of the easiest ways to destroy your financial picture. Run your own numbers and walk in prepared. And never let the dealer redirect your eyes to assure that you don't know what that all-in price is. That's the only trick that actually matters. If you enjoyed this video, make sure to leave a like, and if you did enjoy, you'll love this video as well as this video as well. Thank you so much for watching and enjoy the rest of your night. Take care.